All right, let's talk about SmartCentres REIT. If you're in Canada, you've definitely seen their shopping centers. They are everywhere. Now, most people look at them and think, oh yeah, that's a nice, safe dividend stock. And they're not wrong. But today, we're asking a much, much tougher question. So here it is, the big challenge. Can this seemingly steady, maybe even a little boring company actually deliver a 9% annual return every single year for the next 16 years? Now, 9% might not sound like some crazy crypto number, but let me tell you, when you compound that over more than a decade and a half, you're talking about quadrupling your money. So our mission today is to figure out, is that a real possibility or is it just a pipe dream?
To get to the truth, we've got a roadmap. First, we'll cover the basics of what SmartCentres even is. Then, we're going to get our hands dirty and dig into the financials. After that, we'll look at the good, the bad, and the ugly with a risk assessment. And finally, the most important part, the price tag. What's it actually worth? Stick with me, and we'll have a final verdict at the end. Let's get into it. Okay, first up, SmartCentres 101. Before we can even dream about hitting that 9% target, we absolutely have to understand the nuts and bolts of this company. How do they make money? What's their game plan? It seems pretty simple from the outside, but you know what they say? The devil's in the details.
So let's get this out of the way first. SmartCentres is what's called a REIT. That stands for Real Estate Investment Trust. Just think of it like this. It's a company whose whole business is owning and operating buildings that make money, usually from rent. And here's the kicker. By law, they have to pay out most of that income to their investors. That's us, in the form of dividends. That's why income investors love these things.
So at its heart, SmartCentres is basically a giant landlord. They own a ton of retail properties and they collect rent checks. Simple enough, right? Well, their secret sauce, the thing that makes them so stable, is who their main tenant is: Walmart. Having a rock-solid anchor like that brings in consistent traffic and reliable rent. But, and this is the exciting part for the future, they aren't just sitting back and collecting rent. Their big plan is to take the huge plots of land they already own around these shopping centers and turn them into communities with apartments, offices, the whole shebang. That's where the real growth could come from.
All right, the business model seems solid. Stable rent, plus a nice little growth story on the side. But do the numbers actually back that up? It's time to go for a deep dive into the financials. This is where we see if the story holds water, and if that 9% return is even in the realm of possibility. Now, here's a classic trap when you look at a REIT. You might see their profit margin, over 27%, and think, wow, this thing is a money-printing machine. But hold on. With REITs, those official profit numbers can be really misleading because of weird accounting rules about property values. The number you really need to focus on, the one that tells the true story, is cash flow. And that's where SmartCentres shines because it consistently generates over $375 million in cold, hard cash every single year. And this is the core of their financial strength right here. That $375 million in cash coming in the door, it easily, comfortably covers the $267 million they pay out to investors in dividends. Think about that. That means the dividend is super safe and they still have more than $100 million left over. They can use that to pay down debt, reinvest, whatever they want. For an income play, that is exactly what you want to see.
Okay, let's talk about the other side of the coin, debt. You can't be in the real estate game without borrowing money, and SmartCentres is no different. Their debt-to-equity ratio is 1.43. So, in plain English, for every dollar of their own capital, they've borrowed about $1.43. Now, that's pretty standard for a REIT, but it's something you have to keep an eye on. Debt can supercharge your returns on the way up, but it can also be an anchor on the way down. It's a balancing act.
Okay, so we've got the business model down, and the numbers look pretty decent. But now it's time to put this whole idea to the test. Let's really kick the tires and look at the strengths, weaknesses, opportunities, and threats. This is where we find out if this thing can handle a few punches. This weighted analysis from our source is fantastic. And look what jumps right off the page. The two single biggest factors, both weighted at 20%, are a strength and a weakness in a head-to-head battle. You've got the incredible stability from having Walmart as your tenant, pulling against the risk from all that debt we just talked about. This tug of war is really the entire story of this investment. And this chart just drives that point home visually. Strengths and weaknesses are perfectly balanced, each making up 35% of the total picture. It shows you that, yeah, the opportunities are real, but those internal weaknesses, they're just as important, and you can't ignore them. So, if we boil it all down, here are the top 3 things that could go wrong. Number 1, rising interest rates. That would make all their debt more expensive to service. Number 2, Retail disruption, the constant threat that online shopping will keep eating away at their tenants. And number 3, that high debt level itself, which basically takes the other 2 risks and turns up the volume. And that brings us to the moment of truth. This is the big one. We know the business, we know the risks, but what is it actually worth? And more importantly, what price do we need to pay today to have any hope of hitting our 9% return target? So the analysis gives us a few different scenarios for the company's intrinsic value, which is really just a fancy way of saying what the business is probably worth. In a worst case or a bear scenario, maybe it's worth $22 a share. If everything goes perfectly, the bull case, it could be worth as much as $38. But the most realistic, middle-of-the-road base case, that puts the value right around $30. When you blend all those scenarios together, you get a fair value estimate of $30.45. Now, at the time of the analysis, the stock was trading for about $27. So what does that tell us? It suggests it's a little bit undervalued, maybe a slight discount, but it's definitely not a screaming, table-pounding bargain. And this quote from the source material just says it all, doesn't it? If you have an ambitious goal, like 9% a year, for many, many years, you can't just buy whenever. The price you pay on day one is probably the single biggest factor that will determine whether you succeed or fail. And here we are. This is the answer to the question we asked at the very beginning. This table lays it out in black and white. If you want to achieve a 9% annual return, what price do you need to buy at? And for our 16-year time horizon, look at that, $22. That is way below its current price and even a good bit below its estimated fair value. This tells you everything. To get that high return, you need a massive margin of safety. You have to buy it on sale.
Okay, we've been through the business, the finances, the risks, and the all-important price tag. Let's put a bow on this and deliver the final verdict for SmartCentres.
If you take away just one thing, let it be this. SmartCentres is a fantastic, stable income investment. It's a machine for generating dividends. What it is not is a high-growth, get-rich-quick kind of stock that's going to grow to the moon on its own. Its value is in its stability.
So, here's our verdict. That 5.4% dividend, that's really nice income. And hitting our 9% total return goal, believe it or not, it is possible. But, and this is a huge but, it totally depends on you buying it with a huge margin of safety. In other words, you have to get it at a big discount to its current price. So the final recommendation from the source material is pretty straightforward. Around $27, it's a hold. It's fairly priced. If you want a better chance at higher returns, you should wait for the price to drop below $24. And if you're laser focused on that 9% long-term target we've been talking about, well then your buy price is even lower, down around $22. And as always, a quick reminder, this is just an analysis for informational and educational purposes. It is not financial advice. Please, please, always do your own homework before making any investment decisions. So there you have it, our deep dive on SmartCentres. It's a great, stable company, but the big lesson here is that even with the best companies, the price you pay is what dictates your return. Hitting ambitious goals means you have to be patient and disciplined. So, what company should we put under the microscope next time? Drop a comment below and let us know. Thanks for tuning in.